gold is doing something that should make you pause. It is rising alongside stocks instead of replacing them. When gold and equities move up together, that usually means the stress is not visible on the surface. It means liquidity and credibility are being priced at the same time. And that is a very different signal than fear. Our strategy does not anchor on predictions. We anchor on mechanisms. The real question is not whether gold goes to 5,000 or 8,000. The question is why the structure underneath the system is shifting. There are three forces behind this move. The first is monetary debasement, not as a political argument, just arithmetic. When debt levels expand and interest costs rise faster than economic output, governments historically resolve that imbalance one of two ways. They either default, which is rare, or they reduce the real value of the debt through inflation over time. Inflation quietly shrinks the burden. Gold, unlike paper currency, is not someone else's liability. It does not depend on a promise. That is why, over long cycles, it tends to keep score when the unit of account is diluted. The second force is reserve trust. When foreign reserves can be frozen or restricted, central banks begin reassessing what they actually own. If an asset is someone else's promise, it carries political risk. Gold does not. That shift in reserve behavior creates a structural bid that is not driven by retail emotion. It is driven by policy constraints, and structural flows tend to persist longer than narrative cycles. The third force is the participation gap. Even after a major rally, most global portfolios still allocate very little to precious metals. That means the move so far has not required broad retail enthusiasm. It has been driven by institutional hedging, official sector demand, and gradual capital rotation. When broad participation eventually increases, volatility often increases with it. Now here is where sequencing matters. Hard assets can still pull back sharply during liquidity squeezes. If credit tightens and correlations spike, gold can temporarily decline with everything else before reasserting its structural bid. That is not contradiction, that is phase transition. If you find this type of probability-based breakdown useful, consider subscribing. The goal here is not noise or bold predictions. It is to help you understand how liquidity, rates, and capital flows interact, so you can interpret market moves with more clarity and less reaction. What would confirm the current structure? Continued central bank accumulation, stable or declining real yields, and evidence that dollar funding pressure is not accelerating. What would challenge it? Sustained rising real yields, tightening credit spreads, and forced deleveraging across asset classes. Quick note, this discussion is for educational purposes only and is not investment advice. We focus on frameworks and probabilities, not recommendations. In the end, the durable edge is not guessing the next price target. It is recognizing which mechanism is dominant in which phase. When you understand the plumbing, you are far less likely to be surprised by the headline.